Something changed this week, not in the headlines, not in the press conferences, not in the social media noise, but in positioning. Behind the scenes, military assets have shifted in ways that don't signal diplomacy. They signal preparation. Carrier strike groups are no longer just symbols. Strategic bombers have been repositioned within operational range. Missile defense systems have been reinforced across key bases in the Gulf. Surveillance aircraft are flying expanded patterns. Aerial refueling tankers are on standby. This is not theater, this is optionality. And markets don't wait for missiles to launch. They react when probabilities shift. Right now, the probability of escalation in the Middle East is no longer theoretical. The language coming from officials suggests that a decision window is open, not months away, not sometime next year, but days. When decision windows compress, volatility expands, and most investors are not positioned for compressed timelines, because this isn't just a geopolitical story. This is a gold story, this is a silver story, and the next move may not wait for confirmation. Historically, precious metals do not spike after the event. They move when the market senses inevitability. They move when risk premiums reprice. They move when uncertainty stops being abstract and starts becoming measurable. If traders believe there's a 10% chance of conflict, safe haven flows remain light. At 30%, positioning starts to adjust. At 50%, hedging accelerates. Above that, capital begins to move defensively. We may be entering that zone, and the reason it matters is simple. Gold is already elevated. Silver is already structurally tight. This is not a cold market waiting for ignition. This is a warm engine idling at high RPM. Now consider the broader alignment. Iran is not operating in isolation. Joint naval drills between Iran, Russia, and China have taken place near critical shipping routes. Whether symbolic or strategic, the message is clear. Alignment is visible. When nuclear-armed powers operate within proximity of a potential flashpoint, margin for error narrows. Miscalculation risk rises. Insurance premiums rise. Energy traders begin recalculating supply risk, markets, price, proximity. And the most sensitive artery in this entire equation is not a border. It's water. The Strait of Hormuz. Roughly 20% of global oil supply moves through that narrow channel. It is one of the most strategically sensitive choke points on Earth. If shipping is disrupted, even temporarily, oil does not drift slightly higher. It gaps. Oil doesn't need a full blockade to spike. It needs uncertainty. It needs insurers to hesitate. It needs tankers to slow. It needs headlines suggesting risk. Higher oil prices feed directly into transportation costs. Transportation feeds into goods pricing. Goods pricing feeds into inflation expectations. Inflation expectations feed into bond yields. Bond yields affect real rates. Real rates drive gold. This chain reaction can unfold in hours, not weeks. And if oil surges while economic growth remains fragile, the word nobody wants to hear re-enters the conversation. Stagflation, low growth, high inflation, policy paralysis. Historically, stagflation environments are supportive of gold. Silver becomes more volatile, but often more explosive. Now, layer something else on top of this. Domestic legal uncertainty. At the same time that military positioning intensifies, the Supreme Court is weighing the legality of tariffs imposed under emergency economic authority. The decision could either reinforce trade friction or temporarily ease it. If tariffs remain in place, inflationary pressure persists. Supply chains remain strained. Import costs stay elevated. If tariffs are struck down, there may be short-term relief. The dollar could strengthen. Risk assets could bounce. But even in that scenario, geopolitical tension does not disappear. And here is where things become asymmetric. If escalation happens while tariffs remain intact, markets face dual pressure, energy shock from conflict, trade friction from policy. That combination amplifies inflation risk and increases safe haven demand. If escalation happens, but tariffs are removed, volatility increases because markets receive conflicting signals. Geopolitical stress versus trade relief. If diplomacy prevails but tariffs remain, metals may consolidate, but underlying inflation support remains intact. If diplomacy prevails and tariffs are removed, that is the only scenario that creates a temporary bearish window for precious metals. Temporary, because the structural drivers did not begin this year. They began with debt. Global sovereign debt sits at historic highs. Central banks have been accumulating gold at record levels for multiple consecutive years. Emerging markets are diversifying reserves away from overconcentration risk. This bull market in gold did not start because of one headline. It began because the global monetary system is stretched. Conflict accelerates fragility. It doesn't create it. Now look at silver. Silver is not just a monetary metal. It is industrial. It feeds electrification, solar expansion, advanced electronics, defense manufacturing. Supply growth has lagged demand growth in multiple recent years. That creates a tight structure. In tight structures, price reactions are sharper. And in volatile geopolitical environments, tight markets move violently. History gives us clues. Before the Iraq invasion in 2003, gold began climbing months before boots hit the ground. During the early phase of the Russia-Ukraine conflict in 2022, gold surged rapidly as uncertainty peaked. Markets front-run events. Investors who wait for confirmation often enter after repricing. The question right now is not whether conflict is guaranteed. The question is whether the probability is high enough to justify positioning. And the answer may depend on your time horizon. Short-term traders may face extreme volatility. Margin requirements on futures can rise suddenly. Exchanges can adjust collateral demands. Forced liquidations can create sharp intraday swings. Physical metal does not receive margin calls. That distinction becomes relevant when volatility spikes. We are entering a compressed timeline. Military assets are in motion. Legal decisions are pending. Energy markets are sensitive. Global powers are visibly aligned. When multiple high-impact catalysts cluster within a narrow window, volatility rarely stays contained. It expands, and it expands fastest when investors are complacent. Many still assume diplomacy will prevail quickly. Many assume oil flow is untouchable. Many assume courts will soften trade policy. Assumptions create fragility. Fragility creates repricing. Gold thrives in repricing environments. Silver amplifies them. This moment is not about panic. It's about preparation. Because markets do not reward reaction, they reward anticipation. And right now, anticipation is building. The next few days may define the next few months. Not because headlines are dramatic, but because positioning is real. And once positioning becomes action, markets move without asking permission. Now let's talk about what actually happens next. Because markets don't move on emotion. They move on structure. And structure right now is fragile. There are 4 primary paths forward from this moment. 4 scenarios that determine whether gold and silver consolidate or detonate. Scenario 1. Escalation occurs, strikes happen. Energy infrastructure is threatened. Shipping through the Strait of Hormuz slows or pauses. Oil spikes instantly, not gradually, not politely. If even 10 to 15% of global oil flow is perceived to be at risk, crude can jump $10, $15, even $20 in days, depending on liquidity conditions. Insurance premiums surge. Freight costs climb. Airlines hedge aggressively. Emerging markets feel currency pressure almost immediately. Energy shock spreads like electricity through the global system. Bond markets react next. Higher oil means higher inflation expectations. Higher inflation expectations pressure central banks. If central banks hesitate to tighten because growth is already slowing, real interest rates fall. And when real rates fall in an inflationary environment, gold historically thrives. Now add tariffs remaining intact in this scenario. That's dual pressure. Imported goods remain expensive. Energy costs rise. Consumer sentiment weakens. Corporations face margin compression. Equity volatility expands. Safe haven demand increases. Central banks may accelerate gold purchases as reserve diversification becomes strategic rather than optional. Silver follows gold, but often faster, because silver sits at the intersection of monetary fear and industrial demand. If defense production ramps, if energy infrastructure investment rises, industrial silver demand does not collapse, it intensifies. In a dual shock scenario, war plus trade friction, gold can break resistance levels decisively. Silver can overshoot. That's scenario 1. Scenario 2, escalation happens. But tariffs are struck down. This creates tension inside the market. Oil still spikes. Inflation expectations still rise from energy pressure. But trade relief provides a counterweight. Equities may initially bounce on tariff relief even while geopolitical tension rises. Volatility becomes chaotic. This is the environment where intraday swings expand dramatically. Futures markets become unstable. Margin requirements increase to contain leverage. In this case, gold likely still benefits, but movement becomes more erratic. Silver becomes extremely volatile because silver is thinner. It doesn't require massive capital inflows to move aggressively. A modest reallocation can cause sharp price spikes. This is the whipsaw environment. Not calm, not linear, violent. Scenario 3, diplomacy prevails. No strikes occur, shipping remains uninterrupted. But tariffs remain in place. Energy prices may stabilize. Volatility cools temporarily. Equity markets breathe a sigh of relief. Gold may pull back modestly. Silver may retrace more aggressively because speculative positioning unwinds faster, but the structural drivers remain intact. Global debt has not disappeared. Central banks have not reversed gold accumulation trends. Trade friction still exists. Supply chains remain partially strained. In this case, weakness in metals may be shallow and temporary. Consolidation instead of collapse. Scenario 4. Diplomacy prevails. Tariffs are removed. Energy stabilizes. Trade pressure eases. Risk appetite rebounds. This is the only environment that creates meaningful short-term downside risk for gold. But even here, the downside may be limited, because underlying fiscal realities persist. Governments worldwide are operating with elevated debt-to-GDP ratios. Deficits remain structurally high. Monetary policy flexibility is constrained by political and economic realities. In past cycles, when geopolitical risk temporarily faded, gold corrected, but rarely returned to previous cycle lows if debt trajectories remained elevated. That's the key. The floor has likely risen. Now, let's zoom into oil mechanics. If the Strait of Hormuz experiences disruption, even partial, spare production capacity globally is limited. Strategic petroleum reserves can release supply, but those releases are finite and politically sensitive. Markets understand this. Oil futures would price not just immediate shortage, but duration uncertainty. Duration uncertainty is what causes overshoot. When traders cannot model supply restoration timelines, they price worst-case ranges. That's when crude gaps violently. Higher crude feeds directly into inflation break-evens. Inflation break-evens influence bond pricing. Bond volatility feeds into equity volatility. And when bond volatility rises, portfolio managers increase hedges. Gold is a traditional hedge against systemic uncertainty. Now, consider the dollar paradox. In early conflict stages, the US dollar can strengthen due to global flight to safety flows. A stronger dollar usually pressures gold, but that relationship is not absolute. If inflation expectations rise faster than nominal yields, real yields decline, even if the dollar is strong. Gold responds primarily to real rates, not just currency levels. So you can have a rising dollar and rising gold simultaneously. That confuses retail traders. But institutional capital understands it. Now let's discuss liquidity. During high volatility periods, futures exchanges can increase margin requirements rapidly. When margin increases, leveraged traders must post additional collateral or reduce positions. Forced reductions create sharp sell-offs even in bullish environments. This can create temporary drops in gold and silver, even if the macro backdrop remains supportive. Those drops are not necessarily trend reversals, they are liquidity events. Silver is especially vulnerable to liquidity swings because its market depth is thinner compared to gold. That's why silver often falls harder during forced liquidations, and then rallies harder during recovery. Comex inventories, physical delivery demand, and ETF flows all become critical indicators in such moments. If physical demand accelerates while paper leverage decreases, structural tightness becomes visible. That's when repricing accelerates. Now step back. We are looking at a compressed time window where military assets are forward positioned. A legal decision on trade authority is pending. Oil supply risk is elevated, global debt remains high, central banks are accumulating gold, industrial silver demand is structurally strong, catalysts are clustering. Markets do not like clustered catalysts, they prefer spacing. When catalysts cluster, volatility expands non-linearly. Most investors remain positioned for stability. Stability is the base assumption, but markets move hardest when base assumptions break. If escalation occurs, the first move may be sharp. The second move may be sharper as confirmation hits headlines. Algorithmic trading systems react within milliseconds to keywords, shipping data, satellite confirmation, official statements. Speed amplifies magnitude. By the time television coverage intensifies, positioning has already shifted. That is how modern markets function. And this is why preparation matters more than reaction. This is not about predicting certainty, it's about understanding asymmetry. If nothing happens, metals may consolidate modestly. If something happens, metals may reprice aggressively. That asymmetry is what strategic investors evaluate. Gold is not just a trade in this environment. It is insurance against policy error, geopolitical miscalculation, and inflation acceleration. Silver is leveraged to that insurance, more volatile, more reactive, more explosive. The coming days are not ordinary. They represent a potential inflection point, not guaranteed, but possible. And markets price possibility faster than people expect. Right now, probabilities appear elevated. Energy sensitivity is high. Legal uncertainty remains unresolved. Geopolitical alignment is visible. Debt burdens are heavy. Inflation psychology is not fully reset. All of this creates a fragile equilibrium. Fragile equilibria do not require large shocks to break. They require triggers. The question is simple. Are we days away from a trigger, or will diplomacy extend the clock? Either way, volatility is unlikely to remain suppressed. Because once positioning shifts, it rarely returns quietly. Gold does not need panic. It needs uncertainty. Silver does not need collapse. It needs momentum. And both thrive when the system feels stretched. The market is watching. Energy traders are watching. Central banks are watching. Institutional allocators are watching. The next headline could matter, but the positioning before the headline may matter more. This is a volatility window, a repricing window, a moment where preparation outweighs prediction. Because once the move begins, it rarely waits for consensus, and history shows something consistent. Markets never ask permission before they reprice risk. They simply move.